Hey guys, in this video we're going to be walking through an example of a bond issued at a discount. So my plan is to walk you through my first steps when first approaching a bond question, how I calculate the present value of future cash payments, as well as walking through an effective interest method amortization table. So in this example, our face value is $10,000 and our bond makes cash payments semi-annually for 2 years, and our market rate is 12% and our stated rate is 10%. Remember, these are always given at an annual rate. So the first thing I like to do whenever I approach a problem is to get my end value as well as my correct percentages for my market and my stated rate as well as my cash flows. So remember that whenever you are given interest rates, they're always given at an annual rate unless stated otherwise. So in this problem, since we know that our cash payments are semi-annually, our end value is equal to the 2 years times 2 semi-annual payments to equal 4. And then to get our correct interest rates, we need to divide those by 2. So our market rate becomes 6% and our stated rate becomes 5%. And the reason we're dividing by 2 is because we want to get these interest rates on a semi-annual basis instead of an annual rate as they are given. Now quickly here I can compare my stated and market rate to determine what my bond was issued at. So since my stated rate is 5%, which is less than the market rate of 6%, I know that this bond was issued at a discount. Moving forward, I can go ahead and calculate my future cash flows so that I can determine the present value of those cash flows to confirm that this bond was issued at a discount. So I have my first cash flow of $10,000 face amount that is paid back at the end of the life of the bond. And then I'm also going to have my cash flows for the cash payments I make semi-annually for those 2 years. So to calculate that, I multiply the $10,000 times my stated rate because that's the amount I promised my bondholder. And in this case, I get $500 cash payment every 6 months. And then what I do is I go ahead and I cross out my stated rate and basically throw it out the window because I'm never going to use it again in this problem moving forward. So now that I've determined my future cash flows, really my next step is to discount those to get the present value. And to do so, I'm going to be using an n equals 4 that I previously calculated. And moving forward, I'm only using my market rate, right? So I'll be using that 6% because it's the market rate that's determining this present value. Now, remember when I'm grabbing my present value factor or my discount factor for that face value, I'm always going to be using the present value of $1 because it's a single sum. So in this case, when I'm using n equals 4 and I equals 6%, I get a value of 0.79209. And whenever I'm calculating the present value of my cash payments made during the life of this bond, I'm always going to be using my present value of an annuity table to grab my discount factor because this $500 is paid multiple times. So it's an annuity and not a single sum. So in this case, it is 3.46511. So the present value of my face value is $7,920.90. And my present value of that ordinary annuity of those $500 cash payments that are made over the life of the bond is going to be $1,732.55. And this will sum to a total present value of $9,653.46. So this present value is equal to the amount of cash that we receive for this bond. And since the cash we receive, or that present value, is less than the face value of this bond, this confirms what we had already determined, that this bond was issued at a discount. Sorry guys, my screen recording got a little glitchy here, but what I'm doing next is, since that I know the amount of cash I receive, I'm recording that initial journal entry. And so my first step is to always debit cash for the amount we receive. So in this case, we're debiting cash for that $9,600 amount. And then we always credit our bond payable at face. So in this case, our face value is $10,000, so we're crediting it at face. And at this point in time, our debits don't equal our credits, and so we know we need an additional debit. Discount equals debit, And so since we know our bond is issued at a discount, we know that this missing plug will have to be a debit to a discount on our bond payable for the difference between those two items. So presented on our balance sheet at issuance, we will have our bond payable in the liability section, of course, at that face value of $10,000. And then we'll have our contra liability account, this discount on our bond payable balance of $346.54, and then those will net together to show a net value equal to the cash we initially received, that $9,653 amount. Cool. So moving forward past really issuance and the journal entry that you're recording at issuance, as well as everything else that we had calculated previous to this, moving forward, we're really focused on interest expense as well as the amortization of that discount on your bond payable account. So to start, it's helpful to kind of have a pro forma journal entry of what you'll be making every 6 months, assuming you're making payments on June 30th and December 31st, but you'll have a debit to interest expense and a credit to cash for your cash payment. And then the difference is going to be plugged as a credit to your discount on your bond payable to decrease that discount on your bond payable account. So for this example, I'm going to be looking at the effective interest method, and to calculate interest expense under this method, it's helpful to create kind of a table to help you keep track of things. So you have 5 columns. I always start with the date, and then I move through that journal entry with interest expense first, and then the discount amount, and then your cash payment, and then at the very end I have your net carrying value. So we know that at issuance, our net carrying value is going to be equal to the amount of cash that we received. So we calculated that previously in this question, and it was $9,653.46. Again, that was just the present value of those future cash flows, or the amount that we initially received as cash. The other 3 columns will be blank at issuance. Now, our first interest calculation occurs at the 6-month mark, and to calculate our cash payment, we've already done that. It's going to be that face amount times your stated value, and our interest expense is going to be that net carrying value times your market rate, because we're only using that market rate moving forward in the question, right? So we'll take the 9,600-ish amount and multiply that by 6% to get our interest expense. So in this case, it's going to be $579.21. And so if in our journal entry we know the debit to interest expense is that amount and our credit to cash payment is $500, then we know our credit to our discount is going to be the difference between the two, that's $79.21. And since the goal throughout the life of a bond is to get your net carrying value to equal face, we know that this amortization of our discount on our bond payable is actually going to, in fact, increase our net carrying value. So we'll add that $79.21 to the 9,600-ish amount to get our new net carrying value. Again, I think it's kind of helpful to visualize this on the balance sheet. So under our liability section, our bond payable would be at that face amount, and then we want to calculate our new balance and our discount on our bond payable account. And so to do so, I'm just going to go ahead and draw a T account kind of up in this blank kind of right-hand corner spot here. So at issuance, we had a debit to this discount on our bond payable in an amount of $346.54. And then here, when we're amortizing this discount by that $79.21, we're reducing the account because discount means debit balance. And so the actual balance in this discount on our bond payable account is going to be equal to $267.33. So on our liability, the balance in our discount on bond payable will be that amount, and so the net of those two together will be $9,732.67, which is going to be equal to that net carrying value that we had previously calculated, right? And moving forward in this question, we're going to go ahead and go to the next time we're calculating interest expense at the 12-month mark. And again, we know our cash payment is $500. That never changes, but our interest expense will be the net carrying value times that market rate of 6%. to get an interest expense amount of $583.96. So again, we compare that to our cash payment amount, which is $500, and the difference will be the amount we amortize to our discount on our bond payable account of $83.96. Since the goal is to get our net carrying value to $10,000, we know we'll add that $83.96 to get a new net carrying value at the end of the period of $9,816.63. So again, up in this right-hand corner, but now in orange, I'm going to show what this would look like on the balance sheet. So now our balance sheet at the 12-month mark, again in the liability section, we'll have a bond payable balance of face, which in this case is $10,000. And then we'll have that contra liability account, that discount on our bond payable of the balance. To calculate this, we would have that $267.33 amount, and then we would subtract what we had just amortized, which was $83.96 to get the new balance and our discount on our bond payable. You could put this in a T account, I just kind of ran out of room. And so our new balance and our discount on our bond payable is going to equal $183.37. And so on our balance sheet, if we net those together, we would have a net balance of $9,816.63, as we found when we calculated that new net carrying value amount. I'm not going to go ahead and finish this amortization table because I think it's pretty repetitive, but to do the 18-month and 24-month, you would follow the same steps, but in the 24-month, make sure that you remember in a journal entry, you also have to actually pay back that liability. So you would be debiting your bond payable at that $10,000 amount and crediting your cash for the $10,000 face that you pay back, in addition to your journal entry for your interest expense at 24 months. If we were to approach a bond that was issued at a premium, essentially you would kind of be doing the opposite steps, right? So you would be amortizing a premium account to get your net carrying value to decrease to that $10,000 face amount, etc., etc. So hopefully you found this helpful. Thanks for watching.